Hi, this is Dan Collins, Editor-in-Chief of Modern Trader Magazine, coming to you live from the floor of CME Group for Traders Exclusive. Well, if you have anybody, friends of yours or yourself, still believe in this concept of rational markets, hopefully you've been dissuaded by the last month of activity. We talked to you on the day there was a Brexit vote, and we warned you not to believe that it was that important, and to encourage you to kind of fade any reaction to it. Came back 2 weeks after the Brexit vote. The market, the S&P's dropped 119 points in one day. That morning it opened, almost flat. It was up. It regained about 3/4 of the move before losing it again. We came to you last week, 2 weeks later, and they erased that move. And now, less than 3 weeks later, S&Ps are at new all-time highs. All, in a very, very short period of time. In the summer, when market activity is usually a little bit slower, but it really is a lesson about how markets are irrational. The vote shouldn't have affected our equity markets the way it did. It also is a long-term process. So we talked to you last time that this is going to be a driver of volatility for some time to come, because the Great Britain has to put in the Form 50, which they haven't even done, saying that we're getting out of the EU, and then it's supposed to happen 2 years after that. One little note on that is that the now or soon-to-be former Prime Minister had negotiated a deal with the EU for better terms on that relationship. And the first thing that EU officials said after the Brexit vote, that those terms, those more positive terms for Great Britain are gone. So now it's a worse deal, and a worse deal for perhaps 2 years. So it'll be interesting to play out. It's something to watch because it will cause movement in the market. But the greater point is that the effect on U.S. markets shouldn't have been that strong. So when you see a huge effect, it's something to fade. 2 weeks later, that move was erased. Now we're at all-time highs. It's something that would cause such a huge move. It's erased in less than a month. It's a lesson in how the markets are irrational. Maybe a lesson in how you need to use options as protection, because obviously some very good moves could have been stopped out. You could have lost a lot of money just on the noise. So anyway, you can use options for risk management on longer term out to cover your downside without having to get flushed out of a position is something you need to follow. And it really is a good lesson. Now, are things great? Well, the economy is so weak that we have not, even though after 8 years of zero interest rates, the Fed hasn't been able to pull the trigger on another 0.25% rate. So there is issues with the economy. So the fact that we're all-time highs is kind of odd. If you look at futuresmag.com and in Modern Trader Magazine, we've had a lot of technical studies up there showing that September's often a bad month for equities, as is October sometimes. And with no real fundamental basis for us to be this high, there is risk here. So we're not out of the woods yet. There's a lot of volatility in the market. You could see that the market is kind of squeamish. That's why something that should not have affected it so much caused such a massive reaction. It's like people know it's overpriced. The Fed, has delayed. So there's a lot of risk out there. One thing on the response to a very positive June unemployment report, too. It was sort of what somebody might call a free put on the market. Because there was risk due to Brexit, and the Fed in their minutes said that they did look at it, the market was able to rally strongly on a positive unemployment number. Now remember, usually this causes the market to come back because that would indicate now the Fed can go ahead and tighten, and they sold off. But because there was this other thing, and it happened during the taper area where there was a possibility of a government shutdown, so a very strong report was the market rallied on because they thought there was no risk that the positive news would cause the Fed to tighten. So that's something to keep in mind back there when something like this happens. It was, the traders were free to buy the good news because they thought that it was going to mean another tightening. There is a July meeting. If you could say if the impetus of them delaying in June was a bad May numbers, the June numbers should have, changed that because you had one bad number in it, in the last 5 or 6. But Brexit will probably hold off. Remember, markets are irrational. Don't get caught off guard thinking the markets are great because we made new all-time highs. You can see because of that reaction that people are very nervous, and it won't take much for small negative news to cause a pretty big downward move in the market. So protect yourself at all times. It's been Dan Collins, Editor-in-Chief of Modern Trader Magazine for Traders Exclusive.